Hi everyone, hope you guys are doing good. Welcome to a new video related to home buying series. So in today's video, we are going to discuss about a program called First Time Home Buyer Incentive, which is run by the Canadian government to help people buy their first home in Canada. So this program is pretty new. It started around September 2019. So a lot of people don't really know about it. When I looked up on the internet, there are articles and videos about it, but they're not detailed. So once you go through those videos and articles, you still have a lot of questions and you don't get the answers to that. So I had to do a lot of research, and then I thought I could make a video about it because I am also taking advantage of this program to get my first home in Canada. So before I get into the details of the program, let's clear some basics. So in Canada, if you're buying a house which is costing less than $5 lakh, you need to pay minimum of 5% of the home price as a down payment. Over and above, obviously you can pay anything that you want, but the minimum has to be 5%. Now, if you give only 5% as a down payment, obviously your monthly mortgage or your monthly EMI, as what we call it in India, is going to be high. So that is why the Canadian government has few programs to help the first time home buyers. One of them being the First Time Home Buyer Incentive. The goal of this program is to ensure that your monthly mortgage goes down and you stay within a certain budget. So let's discuss the program in detail now. So in this program, the Canadian government offers you 5% or 10% of the house purchasing price, depending if it's a new home or if it's an old home. This money is offered in addition to the down payment that you're already giving. So as I mentioned in the starting of the video, if you're buying a home which is less than $5 lakh, you have to give 5% from your own pocket. And then depending upon the type of home, the Canadian government will offer you 5% or 10% additionally on top of the 5% that you are giving. Now comes the question of who gets 5% and who gets 10%. The answer is pretty simple. For an existing home, the maximum you can get from the government is 5%. And then if you're building a new home, you actually have the option to take 5% or 10%. The government offers you both, so you can pick 5 or 10 based on whatever you need. Now, once again, remember that the money government is offering you is on top of the down payment that you have to give out of your own pocket. Well, the program is definitely not for free. I mean, why would any government offer you free money? They're just helping you get the home. So they will definitely take their share back. The way this works is it's called a shared equity mortgage. So let's try to understand this better with an example. So let's say you took 10% from the government as the incentive. Then the government holds 10% of the share in your property. So you become the owner of the 90% of the property and the government holds the 10%. Now this may sound a bit weird to you, like why would you want the government to hold any kind of share in your property? But it's going to make more sense when I get into the details of this. Now let's talk about the eligibility criteria for the program. To understand this better, let me take you to my computer screen. So let's talk about the eligibility and qualification criteria for this incentive. So the first point is that you should be a first-time home buyer. So it clearly states that at least one borrower must be a first-time home buyer. And to be considered a first-time home buyer, at least one borrower must meet the following qualifications. So let's look at these qualifications. Should have never purchased a home before, or in the last 4 years has not occupied a home that either themselves or their current spouse or the common law partner owned. Now this term of 4 years actually begins on the January 1st of the 4th year before the incentive is funded and ends 31 days before the date the incentive is funded. So for example, if the incentive will be funded on November 1st, the 4-year period will begin on January 1st and ends on September 30th. Now, if someone has gone through a breakdown of a marriage or common law partnership, then they are also eligible for the first-time homebuyer program, irrespective of if they meet the other requirements or not. The next point is the maximum number of incentives per borrower, or co-borrower, or guarantor. So a borrower, a co-borrower, or a guarantor is only permitted to obtain the incentive once. So in other words, if your spouse has already used the incentive, then if you're applying together for a new home, then you can't use that incentive together. The maximum of one incentive includes any variation of borrower, co-borrower, or guarantor status. The next point is about equity. So it states that the borrower must satisfy the minimum down payment requirements, which must come from a traditional down payment sources. So traditional down payment sources are usually from your RRSP or from your savings account. Non-traditional down payments sources are not eligible to satisfy the minimum down payment requirements. Next point is about income, which is the major one. So the total qualifying income must not exceed $120,000 per annum, and the verification of the total qualifying income is subjected to be set out by the lenders. The next one is mortgage to income ratio, which is also called MTI ratio. So there's a formula to calculate that. So the formula is mentioned here. It's your first mortgage plus incentive divided by the total qualifying income. So it clearly states that the MTI ratio must not exceed 4. In scenario 1, let's say if your first mortgage is for $360,000 and then $40,000 is your incentive multiplied by the total qualifying income, which is $100,000 in this case, then the MTI comes to be 4, and that makes you eligible for the incentive. And then in scenario C, where everything else is the same as scenario A, but your total qualifying income is actually reduced to 80,000, then your MTI becomes 5, which makes you ineligible for the program. The next is about debt service ratio. So for clarity, when calculating the debt service ratio at the time of mortgage, the incentive is not to be considered. So this is actually something your first lender will take care of when you're applying for the mortgage with them. Now, as you would have noticed, under the income requirements, it clearly states that to be eligible for this program, the household income should be less than $120,000 Canadian, right? So in case husband and wife are earning more than $120,000, then they become ineligible for the program. But just in case if someone still wants to utilize the program and take the advantage out of it, what you can do is you can just add one person on the mortgage, whoever has a higher salary between the husband and wife, and then that person can go ahead and take the advantage of the program. That person will be on the mortgage and on the title as well. Now, there are a couple of other things that you should be aware of. So on the screen, you can clearly see about the incentive amount. It states that for existing home, the incentive is 5%. For a new construction, you can get 5 or 10%. And for existing or new construction, mobile or manufactured home, you can again get 5%. Then it talks about the maximum incentive amount. Now, for a 10% incentive, the maximum down payment that you can give is 9.99. And for a 5% incentive, the maximum down payment that you can give is 14.99. Now, the reason why it's specific to 9.99 is because, let's say if you are using the program and you're putting 9.99 as a down payment and then taking 10% from the government, so the total becomes 19.99, which is less than 20%. So you will have to take the CMHC insurance. So here the government wants you to take the CMHC insurance so that it protects the lender. And if you exceed 20%, you don't have to do that as per the law. So in this case, that is why it's strategically placed as 9.99. Now let's talk about the maximum closing date. So the maximum closing date for existing home is 6 months from the time of application approval. And then for the new construction, you actually get 18 months from the time of application approval, which is pretty good. So now let's understand how the government actually takes back the money that they offered you before. As I mentioned earlier, it's called a shared equity mortgage. Now it is like a second mortgage on your house. So the first mortgage will be the mortgage that you will get from your lender or from the bank. And then this money that you took from the government will act as your second mortgage. Now there are 3 options to repay the government. So before we actually discuss the 3 options, there is a term called fair market evaluation, and it's super important to understand that. So fair market evaluation means recalculating your home price based off the current situation. So for example, if you bought the house today for 300,000 Canadian dollars, and now when it's time to return the money to the government, there will be a fair market evaluation of your house. And if your house value is now $500,000, then you have to repay at the rate of $500,000 and not at $300,000, which was your original value. Now let's talk about the case where the price of your home actually decreased. So let's say you got the home for $400,000, but now when you did the fair market evaluation, because of whatever reason, the current value of the home went down to $300,000. And then if you decide to repay the government, now you have to repay them at the price of $300,000 and not at the price of $400,000, which was the original purchase price. So the government actually shares the profit or loss, both whatever happens to your home. Now the reason why it's called a fair market evaluation rather than just calling it out as a market evaluation is because The evaluation is actually done by a third party, which is mutually agreed and approved by the government. So you can be relaxed that the government is not quoting a higher price for your home, and the government can also be relaxed that you are not quoting a lower value for your home. Now this fair market evaluation applies to all the three options. Now let's talk about the option number one. Now remember when I mentioned earlier, technically the money that you're taking from the government is called as your second mortgage. So in option one, you can pay the government back when your first mortgage, which is typically for 25 years, that gets over. So in other words, when 25 years are completed and you're mortgage free, basically your first mortgage is over, that is when you have to pay the government back, but at a fair market evaluation. Now option number two is anytime you want to sell the home. So let's say you bought the home today and after let's say 6 years you want to sell the home. That is when you have to get a fair market evaluation done, and then based off the current price of the house, you have to repay the government the same percentage what you got from them originally. So 5% or 10%, whatever you got from. Now option three is anytime you want to pay it back. In this scenario, your first mortgage is not over yet. So basically you're well under the 25 years limit. And also you're not selling the home, you're still living in the home, but you still want to pay back the government money you took from them initially for whatever reason. You definitely have the option to do that. It will be a one-time payment in full. Also, there will be a fair market evaluation done as it happens in option one and option two as well. So let's talk about the pros and cons of using this incentive. Let's talk about the pros first. So the major advantage of using this program is it is definitely saving you a lot of money monthly over a period of 25 years. Depending upon the kind of money you took from the government, 5% or 10%, whatever you were eligible for, and whatever down payment you need, you can definitely save anywhere from $100 to $400 monthly, and that's over a period of 25 years. To understand this better, I'll take you to a website called ratehub.ca. So let's go to my computer screen. So now I'm on a website called ratehub.ca and I have a mortgage calculator in front of me. I have some hypothetical numbers that I assumed. So the asking price for home is $380,000. And then this shows us the difference between the mortgage amount if we give 5%, 10%, 15 and 19.9. And I have assumed a mortgage rate of 1.79. Now let's compare the mortgage amount if we do not take the incentive versus if we take the incentive from the government. So in the first case where we're just putting 5% down payment for this home, the monthly mortgage is coming to 1552 versus in this case where the total down payment is 15%, where 5% is coming out of your own pocket, and then the 10% is actually the home buyer incentive which you took from the government. So in this case where the total down payment is 15%, the total monthly mortgage payment goes down to 1373. So let's first find out the difference between these two values. We are saving about $179 monthly, and if I multiply it by 12, which means we are saving about $2148 yearly. And then because this is going to run for the whole 25 years, if I multiply it by 25, we're saving somewhere close to $53,000. Now let's assume that you wanted to sell the home after a couple of years, and then the price of your home increased to $400,000. So initially when you took 10% from the government, you took basically $38,000, but now because the price of home is $400,000, now you have to return 10% of the $400,000, which is $40,000. So the difference is only $2,000 just because the price of the home increased. So if I subtract $40,000 out of this, you would still see that over a period of 25 years, you have significantly saved $13,700, which is a direct saving. Otherwise, you'd have to give another $179 monthly if you would have just given the 5% down payment. Let's talk about the cons as well. So the first one is you definitely have to pay it back to the government. So when you buy the house, this will definitely be at the back of your mind that I have to pay the money back. Some people just can't live with it, right? And this is more of a psychological thing rather than anything else. The second disadvantage of using the program would be it actually limits the lender options you have. So when I was in the market looking out for lenders, I figured out not all the lenders are actually interested to give you money if you are using the home buyer incentive. I really don't know why, but that's what I figured out. Majorly all the banks would do it, but then the banks always have a higher rate of interest, right? So in a nutshell, if you're using the incentive, it might lower the options that you have in terms of lenders, but you will definitely find somebody who will be able to give you the first mortgage even if you're using the program. The third and the major disadvantage is using this program, it actually limits your purchasing power. So now let's try to understand how this program actually impacts your purchasing power. So I'm on a website called placetohome.ca. This is the official website for the program. I'll put a link to it in the description. And let's assume some numbers. So let's say the annual income for a person is $100,000, and then they're putting 5% as a down payment, which is $20,000, and it's a new construction they're getting, and the person wants to take 10% from the government as the incentive. It doesn't matter what mortgage rate you put in here, but I'll just put the current rate, which is close to 1.79. And if I calculate, you would see it'll tell me my maximum purchasing price, which is $400,000, which is exactly 4 times of the income that we declared. This program limits your purchasing power to a maximum of 4 times your household income, right? But otherwise, if you're not taking the incentive, the usual mortgage that you can get from any bank or lender is 4.5 or sometimes even 5 times of your salary, right? So let's try to understand this better with an example. Let's say in a household, both husband and wife are working and their combined income is $100,000. So using this incentive, their maximum purchasing price is $400,000. But in case they are not using the incentive and they take a regular mortgage from the bank or a lender, that mortgage could be 4.5 or 5 times of their household income. So now they can get a house for $500,000 versus $400,000, which was the case if they were using the home buyer incentive. So it actually brought down their purchasing power for $100,000, which is a lot of money, right? So in other words, you might have to settle with a house which you really don't like, or you might not be able to buy a house which you like if you have to use the incentive. So the next disadvantage of using the program would be that there will be additional costs at the time of closing, because now your lawyer will have to work on 2 mortgages. The first one will be your regular mortgage that you took from your lender or from the bank, and then the second one will be the home buyer incentive mortgage. Because there will be more paperwork, so the lawyer will charge you more fees, but it will not make a huge difference. It will be a couple of dollars, but I just wanted to bring this up. The last disadvantage of using the incentive would be that there could be additional cost involved when you actually have to switch your mortgage after 5 years. So in Canada, the way it works is your mortgage is actually for 25 years, but you get locked with a particular lender for 5 years, which is actually called a term. So if you are switching from one lender to another after your 5 years term is over, if you're switching to another lender who sees that you are using the home buyer incentive, it might cost you additional money. So that could also be a disadvantage. Now, when it comes to the question of if you actually want to take the advantage of the incentive or not, I would say it's a personal decision, but then you should always consider the numbers while doing your calculations. For example, I live in Calgary, right? I know that the Calgary housing market is not going to boom in the next couple of years. So for me, it makes a lot of sense to use this program. But for somebody who's, let's say, living in Metro Vancouver or in Toronto for that matter, prices of the house are already high there and it's going to increase day by day. So if you take this program, you could be losing money just because of the fact that the price of the house has actually increased a lot. So you should actually consider all those factors and do all the calculations before actually deciding to take the advantage of the program. So let's assume a situation where the price of your home raised exponentially. So let's say if you got the house for $300,000 and after a couple of years your house is now valued at $1 million, which is great. But then if you want to pay back to the government, you'll have to pay back at a price of $1 million, which is definitely an advantage for the government, but then a loss for you because you'll have to pay a lot more than what you actually got from the government. Now, this is a very vague example. I don't see why a $300,000 house would actually raise to $1 million. So that's my point. You have to do the calculation, you have to understand the market, you have to understand the area where you're buying your house, and then go ahead and actually plan if you want to take the incentive. Now you would think that there are a lot of disadvantages of using the program and there is just one advantage. But if you actually spend time and think over it, you will realize that the advantage is more beneficial rather than all these disadvantages or the cons that I talked about. All these disadvantages or cons can actually be managed, and they're not causing a huge dent to your pocket. But if you look at savings, which I talked about under advantages, the savings, whatever you save, $100 to $400, is actually going to stay with you for your whole mortgage period, which is till 25 years. So in other words, I feel that the cons of this program don't really have a major impact over the advantages, but one should know everything before actually making a decision. So that was it for today's video, guys. I hope it was really helpful. I've tried to put down everything that I researched in the last couple of months in this video, and trust me, it was a lot of hard work because the information that I provided you in the video is not really available anywhere. I will be posting some links which actually take you to a PDF document for the first time homebuyer incentive program. Remember, these are also not available on the government website, so I had to kind of figure it out from somewhere. But now, because they are available with me, I would love to share it with you guys. It has all the frequently asked questions and complete details of the program, which I showed you in the video earlier as well. As always, if you like the content, please like the video, share and subscribe to the channel as well. And in case if you have any questions, please feel free to ask in the comment section and I will try my best to respond. Thank you for watching. Bye-bye.